Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
This morning's podcast features Mr. Keith Lanton, with commentary by Brad Harris, Director of Fixed Income at Lanton.
Good morning again. Hope everyone had an enjoyable Labor Day weekend. Hope everyone, if you're in the South, is safe and as prepared as possible in case Dorian makes its way towards the Florida coast. So we're going to get started today, September 3rd. First trading day of September. Typically, September has been in the latter half of the 20th century and the beginning of the 21st century the most treacherous time for equity markets. And we begin this September. Futures are looking negative, and we'll talk some more about that. I'm going to start this morning by building on some of what we've talked about the last 2 weeks, and this is When We Do Things, a book by Daniel Pink, When the Scientific Secrets of Perfect Timing. And going to continue on this topic because I think there's so many interesting items that we can learn from and that we can possibly incorporate into our lives as we think about when to do things. And I had mentioned last week that one of the astounding facts is that when we do things in the afternoon, that our performance suffers significantly. And building upon that, of interest and of note, and something that we all may want to take into account in our lives, is that when we are approaching a task in the afternoon after we've kind of peaked and are beginning to hopefully be able to re-energize. If we take a break, studies have shown that a break causes an improvement that is larger than the deterioration that takes place over the course of a day. And when students, and this is a Danish study, took a score in the afternoon, took a test, their score in the afternoon went down significantly. But scores go up by a higher amount than they even were earlier in the morning after a break. What's interesting is that when taking an exam after a break, studies show that scores are equivalent to spending less time in school each year and having parents with lower incomes and less education. That's when you take a test without a break. But taking the same test after a 20 to 30-minute break in the afternoon leads to scores that are equivalent to students spending 3 additional weeks in the classroom and having somewhat wealthier and better educated parents. And the benefits were even the greatest for the students coming from the lowest socioeconomic backgrounds. And this is something that we need to think about when we do things, that a lot of times we're focused on the what and how to do things, when really the issue may be when we do things, and perhaps we should do things after we take a break if it is in the latter parts of the afternoon. It's interesting that here in the United States there are lots of calls for longer school days, and studies have shown that longer school days may in fact be beneficial, but they need to be accompanied by an appropriate number of breaks. Otherwise, the benefits of spending more time in school for students are compromised by the deterioration that takes place when there is not a respite during the day. To carry this analogy forward to adults and timing, and something that has real life implications, is scientists studied judges, and this is actually a study done in Israel. And the scientists have discovered that in general, judges are more likely to issue a favorable ruling, meaning granting the prisoner parole or allowing him to remove an ankle monitor in the morning, than in the afternoon. Early in the day, judges ruled in favor of prisoners 65% of the time. As the morning went on, the favorable rulings dropped to nearly zero. So prisoners slotted for a 9 a.m. hearing were likely to get parole, while one slotted for 11:45 a.m. had virtually no chance of parole, regardless of the facts of the case. Again, life and death decisions that may impact someone spending an additional 2, 3, 4, or 5 years in prison, very much predicated upon what time of day that hearing is taking place. Now, getting back to breaks. Once judges take a break, say a break for lunch, they once again became more forgiving and more willing to deviate from the default, and the amount of pardons rose significantly, almost to the levels that were experienced early in the morning. But as the afternoon went on, if they did not take another break, then they became more and more likely not to offer parole. In a study here in the United States, scientists studied judges, U.S. federal court judges, and these are amongst the judges that are considered the most educated. And what they found is that on Mondays, after a switch to daylight savings time, people in general lose about 40 minutes of sleep. Judges rendered prison sentences that were 5% longer than the sentences they typically handed out on a Monday morning when it was not daylight savings time, and when they did not lose those 40 minutes of sleep. Now you may say to yourself, what is the amount of break that's most effective? How long should that break be? And what researchers in general have decided upon, and again, this is from taking a break after you've already exhausted yourself, you've used up that energy and that capital. So this is not typically breaks taken in the morning. This is, again, going back to that afternoon time. But in that afternoon time, it's typically best to work for 52 minutes and then break for 17 minutes. Other things to do in order to enhance productivity is to move around, stand up. And what they've also studied is that in the afternoon, if you stand up and go for a 5-minute walk, that after 55 minutes, that is something that is very re-energizing, and the mind resets to levels earlier in the day. What they also found is that you can't put your walk all together. You may say to yourself, instead of going for a 5-minute walk once every 55 minutes, I'll go for a 20-minute walk, and I won't take another walk for another few hours. And what they found is that microbursts of activity are effective, whereas going for a single walk of 20 to 30 minutes does not produce meaningful benefits. It's also interesting that taking that walk or that break outside leads to more meaningful stress relief, and also leads to greater restorative effects. Being close to trees, plants, rivers, and streams is a powerful mental restorative, one whose potency most of us don't appreciate. And finally, when you're taking that break, many of us think we can multitask during that break. In fact, 99% of us, studies have shown, are incapable of multitasking. When people take that break, what they frequently do is perhaps they go for that walk, and while on that walk, they may go on to social media. They may be spending that time texting, even if they're not texting regarding work, and may have nothing to do with a work issue. Nevertheless, the benefits of that walk are significantly diminished. So moving on this morning to the financial markets. Barrons over the weekend talked a lot about this time of year, and the fall and September in particular. Also talked about where we are in the financial markets, and I would say that in general, Barrons came down on the much more cautious side than I've seen them in some time regarding the equity markets, and somewhat uncertain regarding the bond markets, despite the fact that we are at very low historic interest rates. Consensus is that perhaps rates could go lower, or perhaps not. No real consensus. But coming into this time of year, Barrons, I would argue, not as negative on the bond market, despite these very low yields as I've seen them earlier in the year. So just to paint a picture where we are this morning, we're seeing S&P futures trade about 25 points. Actually, it's down to about 18 points now below fair value. This is after the Labor Day weekend where we had that extra day, and what's taken place is the ongoing global events contributing to concerns this morning. U.S.-China trade news, 15% tariff rate on $110 billion of new Chinese imports went into effect on Sunday, as did China's retaliatory tariffs on U.S. imports. In new developments, China said it filed a World Trade Organization complaint over tariffs, and the two sides right now are struggling to agree on a date in September for trade talks. That's according to Bloomberg. To be fair, there is nothing to suggest that tensions have further increased or suggest the two sides won't agree on a date. The news, however, does come amid escalated protests in Hong Kong. Comments from the Chinese saying that they have the right to restore order. Also, UK Prime Minister Boris Johnson is threatening to call a general election for October 14th if Parliament forces a 3-month Brexit delay. That Brexit uncertainty has contributed to further strengthen the U.S. dollar, predominantly at the expense of the British pound. This could also be a headwind for the earnings prospects of multinational corporations, as those pounds and euros the U.S. companies earn get translated into less dollars. U.S. dollar index up all the way to 99.3. It's up 0.4% today. That is its highest level since May of 2017. On the data front, today we will get the ISM Manufacturing Index for August. Consensus is 51.3. We'll also get construction spending for July. Consensus is 0.3%. Both those come out at 10 a.m. Today we'll also get auto and truck sales for August. Those are going to be released throughout the day, giving us some further information regarding the U.S. consumer. Treasuries have edged higher, pushing yields slightly lower this morning. 2-year yield, 149. 10-year yield, 149. West Texas Intermediate crude oil down about $1 a barrel, roughly 2%. Couple of stocks in the news this morning. Boeing in the news following a Wall Street Journal report indicating the 737 MAX 8 jets could be grounded until next year. And Apple in the news, stock trading down about 1%, a little over 2 points. Apple AirPods and Apple Watches will no longer be exempt from tariffs. Apple next week is going to have their get-together where they're going to lay out their new line of products, but that excitement being somewhat diminished by the fact that Apple no longer get that exemption for their products. That's despite the fact the CEO last week was urging the president to exempt them, suggesting that that will make them less competitive, in particular versus Samsung. Barrons over the weekend wrote up Activision Blizzard, symbol ATVI, mentioning the stock favorably. Last Monday, Activision released the World of Warcraft Classic, which is a repackaging of the first edition of the online role-playing game that was popular in the 2000s, and it has generated substantial buzz in the video game world. That product comes with a $15 monthly subscription, and there are reports that gamers having to wait several hours to be able to participate. And on the Amazon Twitch, where you can watch players participate in video games, they're seeing millions of viewers for the new game World of Warcraft Classic, exceeding expectations of what was to come. There's also significant optimism for the new version of Call of Duty. Gamers who have seen the previews rate it favorably, and that has helped the sentiment for Activision Blizzard. American Airlines, AAL, in the news, saying it is extending cancellations of the Boeing 737 MAX flights through December 3rd. And an American had 24 MAX jets at the time of the grounding, but they were expecting to take orders for dozens more, and that has been delayed. American saying they're going to cancel about 140 flights a day through December 3rd. They had been canceling about 115 flights, but as this goes on, the effects are starting to mount for the airlines as they are unable to fly those planes due to those safety concerns. Also in Barrons, Barrons mentioned two companies, two reinsurance firms that they had mentioned previously favorably, and the stocks have been poor performers, and Barrons, in a sense, going back to the well on Greenlight Capital, symbol Golf Lucky Roger Eddy, and Third Point Reinsurance, TPRE, Tom Paul Roger Echo. These are insurance firms backed by prominent hedge funds Green Light by David Einhorn, and Third Point by Dan Loeb. These gentlemen had tried to emulate the Berkshire Hathaway model, where you marry insurance companies and investments, and the marriage has not gone nearly as well as the marriage that Warren Buffett had at Berkshire. But Barrons suggesting that these stocks represent good value. They trade well below book value. They feel that they are appealing at this point. They acknowledge that their previous recommendations have not borne fruit, but they think at these valuations the risk reward has become increasingly attractive, and they're willing to stick their neck out for a further recommendation. A couple of analyst comments, then I'll move on to some of the general comments and Barrons, and then we'll turn it over to Brad to talk some more about the bond market this morning. So, a couple of stocks. Snap, SNAP, was upgraded to outperform from inline at Evercore. Evercore also this morning upgraded Western Digital to inline from underperform. A downgrade in the mortgage REIT space. Annaly Capital Management, symbol Nancy Lucky Yankee, was downgraded to neutral from buy at UBS, and they lowered their target to 8. In the oil services space, we saw Scotiabank come out with a few comments. Kinder Morgan, KMI, resumed its sector perform target 23. Plains Group, PAGP, resumed with a sector perform target 28. And Williams Company, WMB, sector perform 28 at Scotiabank. Some of those dividend-paying stocks in this low interest world that we're in. What do we have to look forward to this week? Today, the Reserve Bank of Australia announces its monetary decision. The central bank there is widely expected to keep its cash target rate at 1%, and 1% these days is a fairly high interest rate there in Australia. Also, I mentioned a couple of the other reports we're looking for today. Tomorrow, the Bank of Canada is expected to announce its interest rate decision, and the futures market is predicting a slim chance that the bank will lower its key short-term rate to 1.5 from 1.75%. On Thursday, for those of you who are football fans, the NFL's 100th season kicks off with the 199th meeting between the Green Bay Packers and the host Chicago Bears at Soldier Field. Also on Thursday, we get Costco reporting its August sales. And then Friday, we get the employment report, which give us further clarity on the state of the economy. This is the report for August. Expectations are for a 3.1% year-over-year rise in hourly wages. The average work week is seen clocking in at 34.4. That's relatively unchanged from the previous month of July. Moving on to Barrons, mentioned lots of concern in Barrons. Last week, raise your hand if you saw this one coming. Despite falling bond yields and continued recession concerns, the Chinese request for calm in the trade war lifted the S&P 500 to its best week since June. Index rose 2.8%, Dow gained 3%, NASDAQ was up 2.7%. And with that, a wild August came to an end, and even with last week's gains, it was still a painful month for investors. The S&P dropped 1.8%, Dow was down 1.7%, NASDAQ down 2.6%. August declines left the market close to pricing in a recession. 10-year yield last month in the month of August fell 0.531 percentage points, its largest monthly drop since 2011. Leaving the markets just about at the concerning inversion between 2s and 10s, and certainly inverted when you look at the 3-month at 10 and 10-year Treasury yields. At the same time, investors, even despite the rally, shun stocks that depend on economic growth for gains. A Merrill Lynch strategist noted that the ratio of the S&P 500 industrial sector index to the S&P 500 has dropped to its lowest level since 2015, as investors are continuing to be concerned about the U.S. Trade war with China and its effects, in particular on industrial companies who are most exposed to China. We are gearing up, as you know, for the 2020 presidential election. and since in the last 60 plus years, there have only been two presidential elections taking place when the U.S. was in a recession. That was in 1980 when President Carter lost, and in 1992 when George H.W. Bush lost to Bill Clinton after the Iraq War there led the U.S. into a recession. And Barron's saying one of the reasons you don't want to get too pessimistic, there's a good reason that presidents don't usually face recessions when running for re-election, and that's because they control many of the tools to prevent one. The surest way now, Barrons pointing out somewhat the obvious for President Trump to prevent one would be to end the trade war. The longer that those uncertainties persist, the greater the percentage chance that we could be in recession, and that's something that would bode better for Democrats and more poorly for Republicans. But Barron's basically suggesting that a lot of the fate rests in President Trump's hands. Barrons also ran a story where they talked about what's to come, and they talked to different market strategists for the remainder of the year. And the general consensus from this poll of investing experts was sort of the best case scenario is very modest gains for stocks based on predictions from market analysts, and a more worst case scenario would be for a more dramatic sell-off. So if you're looking at what the analysts are predicting based on Barrons' polling, is limited upside, but perhaps some upside, and more meaningful downside is what the analysts are suggesting could take place as the year closes out. They are in general all looking for one more rate cut before year end, and then at least two rate cuts in the beginning of next year. They talk about the fact that the major events here that will move market sentiment are trade tensions, economic data, and monetary and fiscal policy as well. Talking about the low interest rate environment, Jim Grant ran a column which talked about living with these negative interest rates, and he mused somewhat whimsically how someone who was around in 1981, which market participants who are 60 plus very much well remember the early 80s and the high interest rate environment. And he muses, I wonder what impulse leads the same human brain that spurned a 15% yield in 1981 to chase a near zero or sub-zero bond yield in 2019. And Jim Grant himself is highly skeptical of these low rates, is worried about rising future rates and future inflation, but he does point out that he is a product of the generation that came of age in high inflation, and perhaps it's hardwired into his DNA to be worried and vigilant for inflation and feeling the effects of the price declines in a rising interest rate environment. So he does take a look at the flip side, and he does said much is different today than the early 80s, and one of those predominant differences he acknowledges is Jeff Bezos, founder of Amazon, the one-man scourge of inflation, and he points out that Amazon has been a driving force for lower prices and competition. He also points out that population growth is declining. Organized labor needs a hug, a nice way of saying they don't have the teeth that they used to have at the moment, and those are forces that perhaps are pressing on the deflationary side of the argument. On the flip side, he does emphasize that interest rates in general are upwardly sloping or higher going the further out that you go. And he said this is, in his opinion, based on a very basic human instinct, and that is the human instinct for impatient. impatience. Most of us want something and we want it now, and therefore those who are willing to put off consumption now typically need to be rewarded for doing that, and the way that they are rewarded is in return for them not consuming. They put their money in a bank who can lend it to someone else who will consume, and in return they will earn a positive or higher interest rate the longer that they are unable to use that money themselves. Yet we're in a world where that is not the case, and Mr. Grant speculates if the argument could be made, and I would say that my interpretation of this article is he's not fully buying the argument, but that doesn't mean he doesn't feel it has merit. Is the argument that you're willing to accept a low interest rate or a near zero interest rate if you believe that the value of money is destined to appreciate, not depreciate. So in an inflationary environment, the value of a dollar today is worth more than a value tomorrow. But if you think that the value of that dollar is going to go up in value, in other words, it's going to be worth more in the future than it is today, then perhaps it would not be irrational to accept a negative interest rate if that appreciation were offsetting that negative interest rate. So talking about negative interest rates, how and why they may exist, we'll emphasize that Jim Grant, the author of the article, would in no way necessarily suggest that he is in the camp that negative interest rates are something that he can wrap his mind around. Nevertheless, something that exists and is undeniable at the moment. Talking about what and where to invest in this environment, Barrons talked about the fact that what has worked best this year is a 60-40 allocation to stocks and bonds, something they recommended a couple of months ago. And if you were in a 60-40 portfolio, last year you would have been down 0.6%, which isn't too bad considering the S&P was down 4.4%. And if you were to look at it this year, a 60-40 portfolio would be up about 14.4%, and that is not too bad when you compare it to the equity side of the market, just a couple of points of underperformance with a lot less volatility. And if you look at a 60-40 portfolio for the past 12 months, again 12 months on a calendar, you would have gotten 5.53%. Better than the 2.3% you would have gotten from pure equities. Barrons also talked about where to invest in this low interest rate environment. They came up with the suggestion to consider investing in the consumer, who they feel is better situated, even if we go into recession, than, let's say, businesses. And they suggest taking a look at investments that make investments in things like residential mortgage-backed securities. They suggest taking a look at funds that invest in ones that aren't insured by government agencies. They mention the PIMCO Mortgage Opportunities and Bond Fund, PMZIX, yields around 3%. And they also talk about looking at dividend-paying stocks. A lot of headlines last week that dividend-paying stocks, the yield on the S&P 500 exceeded the 30-year Treasury yield. That's the first time that has happened, I believe, since 1958. I could be wrong about that, but I think that's what I read. But S&P 500 yield now exceeding the 30-year Treasury yield. And they suggest taking a look at some select REITs, for example, that are residentially oriented, like Avalon Bay, AVB, and Equity Residential, EQR, dividend yields of 2.9 and 2.7%, respectively. They also talk about, and this will be a great transition to Brad, talk about the bond market. They talk about municipals looking very attractive relative to treasuries. This is partly attributable to the fact that it's a market more oriented to the U.S. and therefore perhaps offering relatively more attractive yields. And I'll turn it over to Brad now to talk some more about the markets. Good morning, Brad.
Hey, Keith. Thanks very much. Hope everyone had a great Labor Day weekend, peaceful and calm, and back to work. Just a couple things. I would like to say that I am absolutely of the Jim Grant mentality and camp. I'm third-generation municipal bond trader, and I was brought up in an environment of always fearing higher rates, even though my whole career has scanned through the biggest bull market in history. So that being said, you always have to be involved. You always have to keep your your eyes and ears open. But there are times over the years where you have very significant drop, and you, as bondholders, can get very unnerved about having the safest part of your portfolio drop 20% on paper. Granted, of course, you do get your money back at maturity. It's not comforting to watch a 20% drop on your bond portfolio, though. I used to love to say to my friends that rates can only go to zero, and now I can't say that anymore, which is a little bit frustrating. And in my opinion, and I do emphasize my opinion, it's insane. I think that what could potentially happen is if the Fed does cut rates and we get back to a normalized yield curve, the target rate for the Fed right now is 2 to 2.25 on short term. And if we go to 1 and 1.25, there's no reason that the 10-year can't go from 1.5 back to 2.5, or the 30-year can't go back from 2 to 3.25. Because to have a range of very short-term rates at 1.25 to very long-term rates at 3.25 is not unusual, and that would be a very normalized yield curve, which I hope that one day we see again, because it will mean that we will be at a peaceful place economically.
Thank you, Brad. And despite these low interest rates, you can see that the tax equivalent yields in municipals may still look enticing. You have to decide what makes sense for you, and you could certainly be subject to an environment where even if rates even continue lower, that you could have an uptick in yields and a significant decline in price, either permanently or temporarily. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.